Hello everybody and welcome back to my YouTube channel. I am so excited to have you here with me today. If you are new here, welcome. My name is Rachel and I am a speaker, an author, a business owner, but most importantly for today, I am an accountant. So I run my very own accountancy practice, and through doing that, I get asked lots and lots of questions from business owners, and how to plan and save for tax is one of the #1 asked questions that we receive. Planning and saving for tax is absolutely huge for business owners, not only because of the anxiety associated with knowing how much tax you're going to have to pay, but for cash flow planning and knowing how much profit you've made within the year. So it's our job as accountants to guide you through that journey and to really help you understand not only how much tax you've got to pay, but how we got there, and to really make you feel confident in understanding your numbers and your tax. So I am really excited to talk you through how you as a business owner can save and plan for tax throughout your financial year. So let's take it away. So whether you are running your business as a limited company or as a sole trader, one thing is certain, and that is taxes. So it's my job today to take you from dreading your tax bill to planning ahead and feeling confident. Setting money aside each month for your tax bill will get you ahead of the game and relieve all of that financial anxiety. So if your business is incorporated and you are a limited company, you should be saving for corporation tax and then the associated personal tax to go alongside how much you've withdrawn from the business throughout the financial year. If you are a sole trader, you should be saving for the self-employment taxes and personal taxes. In this video, I'm going to talk you through both types of taxes and advise on how much you should be setting aside for your tax bill. I'll also be explaining what payments on account are, which is a super important part of being self-employed. Specifically, if you are new to being self-employed, it's very important that you pay attention for this bit. I have time-stamped below into chapters corporation tax, personal tax, and payments on account. So if you're not incorporated and you don't need to hear about corporation tax, you can just skip ahead and get to the right place. Okay, so first up, we are going to be talking about corporation tax. Corporation tax is the tax that is applied to the taxable profits of limited companies. Right now, in 2021, corporation tax is a flat rate of 19%. If you're keeping your accounts up to date month on month using software like Xero or QuickBooks, or you've got a really good handle of what your taxable profits are each month, then it's going to be really easy for you to set aside some money each month to put towards your corporation tax, ready to pay it 9 months after your financial year end. So each month, we advise clients to run a report on Xero or QuickBooks once your bookkeeping and accounting software is completely up to date, and apply a flat rate charge of 19%. Now, it's important to remember that there are differences between taxable profits and accounting profits. So the profit that displays in your accounting software might end up being slightly different to the taxable profit declared on your tax return. So this is only approximate, but for lots of businesses, a simple flat rate of 19% each month is a really good rule of thumb, and it goes a long way towards contributing towards your final corporation tax bill. One of the best bits of advice that I can give you, on top of popping aside 19% of your profits each month, is to prepare your accounts really quickly after your year end. If you're preparing your statutory accounts pretty quickly after your year end, that gives you plenty of time to top up any shortfall or spend the surplus. Also, it's really important that I mention not to forget that anybody receiving dividends out of the profit will need to make sure that you are saving for personal tax on those dividends. Which brings me very nicely on to the personal tax piece. So how much you should save for your self-employed taxes is slightly more complicated than corporation tax, because corporation tax very kindly is a flat rate tax. The self-employment tax bands range from 0% all the way up to 45%, so it can be a little more tricky to work out exactly how much to save for these taxes, but I'm going to try and help you on your way. So I did mention earlier that I run an accountancy practice. There's lots of links in the description to this video, so if you are interested in becoming a client of ours, I would absolutely love to speak to you. And the reason I'm mentioning that now is because clients of ours have exclusive access to our app, and our juicy beautiful app provides you with a really easy calculator to help you work out the tax charge for your financial year. So it really is incredible. HMRC also have a great tax calculator, which I will include in the description box below. And just to super quickly explain why these calculators give you approximate figures rather than final actual figures which will exactly match your tax return, I just wanted to explain some of the differences and reasons behind the differences. So if you have other income or self-employment income which is utilising your personal allowance throughout the year, this might push your self-employment income into a higher tax tier than you normally would be. So when you are using our calculator or the HMRC calculator, it's really important to pull together a whole picture of your personal income and not just enter one type of income and just save for that. So when using calculators, zoom out, enter your whole personal financial situation, and then hit go. So because of the way that self-employment taxes are calculated in bands, the calculators really are the best way to go. Ours is fantastic, and you can enter different income sources and different revenue streams and get one taxable figure at the bottom, so you know exactly how much you should be saving for tax. Because self-employment taxes are so complex, using calculators like ours or HMRC's are really the best to get an accurate picture and a confident picture. So you can save money throughout the year and be really comfortable and happy by the time your tax bill arrives. Okay, so if you are self-employed, this section is very, very important. Not only because if you are newly self-employed, this could be something you are not expecting, but secondly, because it is something that a lot of people find quite confusing, and it is a question that we get asked all the time. So I'm going to be talking about payments on account. So most self-employed people are required to make tax payments each year on the 31st of January and the 31st of July. If this is your first year of self-employment, you may also be required to pay 50% of next year's tax on account in addition to the tax due for your first year. So don't panic, I'm just going to break it down for you. If your first year of trading is April 2020 to March 2021 and you make £50,000 of taxable profit, your 2021 tax and national insurance contributions for the year will be £12,336.04, according to our lovely calculator, which you will be required to pay on or before the 31st of January 2022. So that all makes sense. You're paying tax on the taxable profits for that year by the deadline. That all makes sense. However, also due on the 31st of January 2022 will be 50% of the tax due for this financial year to be made on account as a contribution towards next financial year's tax bill. So £12,336.04 is due for the tax year that's just ended by the deadline of the 31st of January. You'll then also have to pay an extra 50%, which for you this year is £6,168.02 as a contribution towards next year's tax bill. That's a payment on account, and if your profit and tax is less than that, it is a payment on account, so it will be due back to you. So in January, you are due to pay 150% of your tax bill at the 31st of January, and then when it comes to the 31st of July, a further 50% as a second payment on account of the same amount will also be due by the 31st of July 2022. So 100% of your tax bill for that period has been paid. You've already paid forward 50% for the first 6 months of the year, and then at the 31st of July, another 50% payment is made. Don't worry though, because these extra payments are held on account to reduce the amount that you pay at the 31st of January 2023. But it does often come as a shock the first year you are self-employed. Lots of people don't know that this happens. Especially if you've been saving really diligently towards your tax bill, you might have saved 100% of your tax bill, but actually that first bill is going to be 150% due by the same deadline. So if we prepared your accounts and you had paid 150% of that first tax bill by the 31st of January 2022, you'd then made your second 50% contribution on account by the 31st of July 2022. Let's take a look and see what it would look like at January 2023. If in your second year you made £60,000 profit, whereas you'd made £50,000 the year before, then on that £60,000 profit, there would be £16,558.20 of tax to pay, minus the two payments on account that you've already made, the first in January and the second in July. So that's the tax due less the two payments on account, which leaves a £4,200 tax top up to pay, and then you need to pay 50% of that tax bill towards your next tax bill. If all of this sounds rather complicated, there is a rule of thumb that lots of people do follow, and that is to save 1/3 of your profits towards your tax bill, whilst also asking your accountant to prepare your tax return as soon as possible after the year end, so that you have a really long time to make sure that you've got the cash to pay. This way you've got the accurate tax figure way before you need to pay the tax. Also, the other advantage to preparing your tax return early is that you can apply to reduce the July payment on account if your profits decrease compared to last year. It is important that I remind you that there are penalties for late submissions of tax returns, and interest is due on late payments of tax, which is another reason to get an amazing accountant and to keep your taxes up to date and safe for your tax bill. If you have any questions on anything that I have run through today, I would absolutely love to hear from you. So if you are not already a client and you are thinking about becoming one, you can use the links in the description below to book some time with me, and we can have a cup of tea over Zoom and chat about your business. If you are a client of ours, we would still absolutely love to hear from you and would love to answer any questions that you've got. Please do let me know in the comments what you thought of this video and if this was helpful for you. I'm all about creating the content that you need and that I wish was out there when I became a business owner. So thank you so much for spending some time with me today. I've had the absolute best time. Please do subscribe to my YouTube channel so that you can get notifications every time I release a juicy video just like this one. If you like this video, please do give it a thumbs up. Thank you again for spending some time with me today, and I hope to see you again very soon.